to learning. Come on, Tiki. Whew. Okay, let me calm down. All right, y'all. Let's get started. Investing in mutual funds. What beginners need to know. And this is being presented by Black Girl Magic Masters, LLC. You already know we trying to say this whole motherfucking universe. And I'm on a mission to restore my community financially. Period. Point blank poo. So let's get into it. Right? Shall we? Knowing the basics. What is a mutual fund? Well, it's these management investment companies that pool money from investors to invest in an actively managed portfolio of securities with the goal of making a profit for the people that invested in them. Okay, let me say that again. Mutual funds, well, they're management investment companies that take money from investors like you and me and put it into an actively managed portfolio of shares and securities with the goal of making money profit for us that we invested in it. You know what I'm saying? So anyway, let's move right along. How do they work? Well, traditional mutual funds are open-ended investment companies, okay? They're sold through a continuous primary offering, not secondary. Now, many of the rules from the Securities Act of 1933 apply here. So when an investor like yourself or me buys shares or securities in a mutual fund, we receive fresh, newly issued shares from the mutual fund in exchange for our investment. Now, mutual funds don't trade on the secondary market. I just want you to know that, okay? Only directly with their investors, okay? The investors of the mutual common stock in the fund itself. But the fund is free to invest in whatever fund it chooses, just so you know, okay? Now, there's this federal law that regulates the activity of investors. It's called the Investment Company Act of 1940. The unit investment trust, two things you need to know. They see companies that pool their money from their individual investors and then invest that money into a portfolio of securities. These are investment companies and insurance-based securities, right? Now, they invest in a fixed portfolio. Fixed is the operative word here, meaning they don't change, of securities that don't change over time because they're not really actively managed. So there's no management fees. And the second thing is these are what we call redeemable shares, redeemable securities, where the investor gets their money back directly from the issuer. And they can't sell their shares to another investor on the secondary market. Now, that needs to be noted now. Here's some ways to earn money through mutual funds. You have dividend payments, you have capital gain distributions, and then you have that increased net asset value, right? Where dividend payments are a reward given to shareholders who have invested in the company's equity or usually originating from the company's net profits. You know what I'm saying? Then you have the capital gains distribution. One of the ways that funds make money for you is to sell these assets at a gain, right? So if the mutual fund held the capital asset for more than 1 year, the nature of the income from a sale of that capital asset is called a capital gain. And the mutual fund basically passes it on to you as capital gain distribution. And then, like I said, you have the increased net asset value, which represents the funds per share market value. It is the price at which investors buy fund shares from a fund company. It's the bid price. You know what I'm saying? Moving right along. Now, did you know the average mutual fund returned 8.99% average mutual fund return for the past 5 years? Hey, now that's dope. I mean, you know what I'm saying? But if you look over here in the corner right here, I put another little a visual for you to see that there's this company called Franklin India Blue Chip Fund. Their average return for the last 5 years was 18.98%. It was 9.42% last year, but I'm just wanting y'all to know, like, shoot, it's not, anyway. So here's some smart strategies that work because you can be one of three investors: an aggressive, moderate, or conservative investor. Now, They have what we call load fund. A load fund is a mutual fund that comes with a sales charge or some kind of commission, because the fund investor pays the load, which goes to compensate a sales, to the intermediary, such as a broker, financial planner, or investment advisor, for their time and expertise in selecting the appropriate fund for that investor. But anyway, you also have the no load funds, which usually don't charge any sell fees or commissions as long as you keep your money invested for a specified period of time. Oftentimes it's about 5 years. You know what I'm saying? Moving right along. So an investment fund that is broadly invested across multiple market sectors, assets, and or geographic region, that's a diversified mutual fund. Okay, it holds a breadth of securities or shares, often in multiple asset classes. Its broad market diversification basically helps you prevent that idiosyncratic event in one area from affecting the entire portfolio. Like if somebody fails right here, it won't knock all your... Anyway, did you know there was 8,115 funds in the U.S. market in 2015, but it's only 7,629 funds as of 2021. So are we going down in these mutual funds? I just thought I'd bring that little notation up, because the number of mutual funds in the United States from 1997 to 2021 has pretty much been between 6,000 and 8,000. Right? But I just thought that would be a fun little visual to see. Now, the leading mutual fund groups globally as of March 2022 by asset under management: BlackRock, Vanguard, Charles Schwab, come on, JP Morgan, Barclays. Let me just tell you a little story about JP Morgan Chase because we might have to do a part 2, a little 3 point. Well, anyway, I'm going to tell you a little story about JP Morgan Chase if we have a little time at the end of this little video, right? But your boy, you know how he started his business, right? JP Morgan Chase, okay? Now, New York had a water problem. Matter of fact, New York back in the day, their water was going through some old wood and it was causing everybody to get sick, right? So JP Morgan had the smart idea to say, you know what? Let's get everybody to pool their money together so we can get a new waterway system. And I'll just hold the money. Well, he got all this money. He took the money and created his own bank and left everybody hanging. And nope, they did not get that water. But anyway, maximizing mutual fund investments, using no load funds, using index funds, dollar cost averaging. Now, how do you start investing? You identify an investment objective, period, point blank. You determine your time, how much time you want to do this, and then you choose a mutual fund investment, right? Now, balancing different classes. Diversification works by spreading your investments among various asset classes: stocks, bonds, cash, T-bills, treasury bills, real estate, precious metal. Now, I have videos on 12 ways. We have talked about this in past videos, but basically the different assets should have a low correlation to each other, meaning they move in exact opposition, and if one of them falters, it won't mess up your whole portfolio situation, right? Now, you got the money market funds, you got the balance funds, you got the bond funds, stock equity funds. Now, I can break those down for you, but I don't think I got enough time in this 10-minute video because I want to talk about the cons of mutual funds. Okay, y'all know, no, damn it, y'all, we're gonna have to do a part 2. Yes, I just realized that we're gonna have to do a part 2. I'm so sorry, y'all. We're gonna stick a pin in the type of mutual funds right there. And I just want to say, class, you have been sitting here for 10 minutes learning about mutual funds. I am so proud of you. I am so proud of you. And because you're here, it means that you are interested in building generational wealth or just getting right on track. And I'm here for it. I'm here for you. Matter of fact, see you in the next video. Love you to life. Oh my God. I love y'all. Like to life.